Hello and welcome back to the Ideal Wealth Grower YouTube channel. My name is Axel Mayhofer and I'm the founder of Ideal Wealth Grower and the host of this video today. So this is the next video in a series basically where we're going into describing and explaining a little bit how the name Ideal Wealth Grower actually came together. Now, if you've been visiting our channel, you would have seen that I have already described in the context of our mindset manual that, by the way, you can download for free at idealwealthgrower.com. In the context of the mindset manual, we talked about how do we actually help people through mentoring and coaching to get on the path towards the time freedom point, which is the point where you have enough passive income coming in to have the freedom to decide what you want to do with your time. So the passive income is covering all your expenses and you can basically decide, do you want to continue to work? Do you want to do other things that you're passionate about? Do you want to go travel? Do you want to hang out with the family and so forth? So in that context of the mindset manual and the overall description of how we actually go about it, we described the part that in the name is grower, because that's a model that I developed to help actually structure how we go about the mentoring and coaching. And what we all want to develop is and grow is our wealth. So what we were left with is ideal, and yes, naturally everybody wants to grow their wealth in an ideal way, but ideal is also an abbreviation. So in the first video of this series, I talked about the letter I, which stands for income. And recently I talked about the letter D, which is being used in two different ways. One is deductions, because you have deductions that you can use as a residential real estate investor in the context of your tax return, and part of those deductions is depreciation. So some people use the depreciation term, others use the deduction term, but that's what the D stands for. And so today I want to talk to you a little bit about the E, which stands for equity. And most people, if you are interested in finance, in money, in currencies, in anything like that, or the economy, and you hear the term equity, you oftentimes or most often hear it in the context with stocks or shares, right? So we have the Dow Jones index, and we have the S&P 500 index, and the NASDAQ index that has mainly technology shares in it and so forth. And all these shares, as kind of like a summary term, are called equities. And where does that come from as a word has to do with the fact that when you buy a share or a stock in a company, whether it's a private company or a publicly held company, one of the things that you are entitled to through ownership in this company by having these shares is how much value you would basically get, and ideally the equity in a company. So what is the worth of the company is when you take everything that the company has. It might have machinery, it might have furniture, it might have patents and proprietary things that it developed, it might have a building, all kinds of things. Everything that basically is owned by the company, and that were divided up in the number of shares, that's the equity that you would get. Now, how does that rely or relate to what we're doing at Ideal Wealth Grower? Because as you know, our strategy is to invest in out-of-state turnkey residential real estate and not in stocks. And the point there is that the idea that something has a certain amount of value that belongs to you as a share of the overall, that is the same concept. So let's take an example. You are in the market, you have worked with us, we have gone through your personal balance sheet, we have looked at where are you right now, how much money comes in, how much money goes out, how can we actually get investing, and we actually identified you have now $25,000 in your accumulation account and you are ready for your first investment property purchase. With that in mind, we go out and we actually look for properties, and we find a property that a turnkey provider offers to us, and that property is on the market from the turnkey provider for, let's say, $100,000. And you look and work with your bank or with your lender, and to make everything as easy as possible and avoid mortgage insurance and everything like that, you agree with the lender to put 20% of that price that the turnkey provider wants down. Right? Meaning like you putting $20,000 in and then the bank is paying the other $80,000. And then you go out and the bank actually goes out and says, okay, well, to make sure that the property really is worth $100,000, we want to get an appraisal. So they go to a national appraisal company and say, here's the address where we have a customer who wants to buy this property. Please go there and appraise it and tell us what, based on your experience and the surrounding neighborhoods and comparative analysis, how much is this property worth? And so the appraiser goes out and actually looks at the property and makes a report and sends it to the lender, and then the lender shares the report with you. And the result of that appraisal is the appraiser thinks this property is worth $105,000. So you buy the property from the turnkey provider for $100,000. The bank is happy because they know, yep, it's worth $100,000. It's actually worth $105,000, and you put $20,000 in. So the first question at that point, you just closed, the property is now yours. What's the equity? And when you look at that and go back to the thing that I said at the very beginning, that the equity would be what is your part of the ownership after every obligation has been paid, would be your part is the $20,000 that you put in as a down payment. And if you actually look at the $5,000 difference between the 100 and the 105,000 that the appraiser said, that is value that is in the property, because with an appraisal, this appraiser actually says in this particular neighborhood, you would be able to ask up to $105,000 for this property and probably have a reasonably good chance to get that. So your $20,000 plus the $5,000 in the appraisal that are above and beyond the sales price, that's the equity at the day of purchase. So in this case, $25,000. That is also one of the reasons why a lot of people say you make the initial benefit, the initial answer to was it a good deal or was it a bad deal, already for the first time when you purchase. So in this case, you could say that's a pretty good deal because at the day of purchase, you already have $5,000 additional equity in the deal. So now let's move 1 year further and look at what has happened. And you get a report from your property management company, and they have received an analysis of all the real estate in the area. And in that area where your house is, real estate has appreciated, like it was, for example, in 2020, by 10% on average. What does that mean for you? Your $105,000 house has increased, let's say for easy calculation, by 10%. So that's $10,500. And you add those $10,500 to the original appraisal, so it was 105 and now it's 10,500 more, so that's 115,500. And again, after that year, after the year 2020, let's say we purchased in 2019, we reviewed 2020, it increased 10% in value, and when you look at it, now it's 115,500. What's the equity? Well, the equity is a little bit more tricky to calculate. So remember, you put 20,000 in. The value, if you just say increase plus appraisal value, is 15,500. So that's 35,500. But keep in mind, throughout the year, you also paid off the mortgage a little bit. So let's just say you paid off the mortgage by $1,000 just to keep things easy. So it's 20,000 plus 15,500 plus 1,000. So it's 36,500 is now your equity. And that keeps going year after year. So your equity is not just a number that is the same all the time. And why is this overall ultimately relevant? If you look at this for a little bit of a longer period of time, 3, 4, 5 years, you might get to a point, or you're most likely going to get to a point where you originally paid $100,000 and now the actual value through increases and what you pay down and so forth is maybe, let's say, at $145,000 and you have paid down the mortgage by $5,000. So that would mean between how much you still owe and how much the property is worth, you have $50,000 in there. And there is a way to use this equity, and I made another video called Velocity of Money, where you can go to a bank and say, hey, if you appraise this property now, it would come out at 140 or 145 or maybe even 150,000. And I want to borrow against this equity that is sitting in this house. And in most cases, they would give you 70 or 80%. So let's say the equity were 50,000 that is sitting in that property. They give you 80%. So that's 8 times $40,000. And you could take those $40,000 that you get as the equity loan or home equity line of credit and use it as a down payment for the next property or two. So that's why equity in the overall scheme of ideal, I for income, D for deductions, and E for equity, is so important, because over time it can actually help you to accelerate growing your portfolio. When I first start with a client, and we oftentimes look at, okay, what is your time freedom point number? Meaning, like, how much money does really have to come in on a monthly basis so you can say, I don't need to exchange time for money anymore because I get enough passive income. And you go and say, okay, let's just say that number would be $3,000 a month, just for the sake of argument. And each of your properties on a monthly basis produces $150. Right? So that would mean on first glance, you need 20 properties, and it would sound like, wow, if I can only buy, let's say, one per year, it would take me 20 years to get to 20 properties. But now you can see, now that you understand equity, it's not buying property by just putting $100 or $200 or $500 aside every month and hope every time you have 20 or 25,000, you can buy another property. The cash flow that comes in that you're not consuming, but more importantly, the equity that is building in your property allows you to sooner or later, a few years into from the first property purchase, to borrow against it and get another property kind of out of step. So while you keep saving and using your passive income to keep saving to buy more properties, this equity gain is also helping. So out of your own pocket, your own savings, your own passive income, you might ultimately end up getting 10 or 12 properties. And you get maybe 2 or 3 properties purely on the equity. And the other thing is what's called father time, because over time you will not just have $150 in passive income, because every time you increase the rent, let's say you increase the rent for your properties every 2 years by $100. That's almost 100% of the $100 going into your passive income. So to get to your $3,000, you won't really need 20 properties. You probably need 13, 14 properties. That still sounds like a lot, but when you really sit down and go through the plan, you can see that the time period to get there typically comes out to be 8 to 12 years. And again, that also sounds like a pretty long period of time. But if I were to say, take your age right now, add 12, 13, 14 years and say, how would it be if at that age you would never have to work again? Then it becomes a little bit of a different thing, because that would be then the age when you reach your time freedom point and you can decide, do you want to work or not do you have to work. Right? So that's why we're doing this: income, deductions, and equity. And next time we talk about appreciation. So if you're not already a subscriber, I would like to ask you to become a subscriber. Ring the little notification bell. If you like the video, give it a thumbs up. And one thing, if you like to be in one of our videos where I can have an interview with you, or you know somebody who likes to have an interview, so we can have a discussion about residential real estate investing or investing in general, and where we are in the current time, and prepare for the future so that our future is bright and we can hopefully all reach our time freedom point sooner rather than later, then please put a comment under the video or contact us directly through idealwealthgrower.com so we can get in touch with you. So for now, be well, stay safe, and I see you in the next video.